We are live. Good evening, everyone. And today we start with Ind AS 8 that deals with accounting policies, estimate changes, and errors. Right. So, very important standard. This standard is more on theoretical aspects. You need to understand what the standard wants us to do, and accordingly, you have to solve the questions in the examination. This will not involve lot of numerical calculations, but this standard can be combined with any other standard and they can give a question in the examination. For example, they may say that depreciation method has changed, or they may say they have done an error in valuing, let us say, some assets, okay, or in calculating depreciation. So that standard plus this standard combined, when it comes, it becomes difficult. And one very important thing here is this is quite different from accounting standard 5 that we learn, in the sense of how do we deal with changes in accounting policies, and how do we deal with errors in accounting. I hope my audio video is clear, and if yes, you can just let me know, and we will begin that. Good evening, Nisha. Good evening, Varashri. Volume is low. Okay, just a second. Is it better now? I think I'll go back to the system default. That is, I think, would be better. You may have a look at your audio video settings, video audio settings actually at your end. Now there is one small change in this particular standard which I have covered in the RTP video itself, right? So there is a change in the definition of what we say the accounting policy, right? So accounting estimates are not policy. There is a change in accounting estimate which I have anyways covered as a part of RTP. Now, as per the new definition of accounting policy, just a moment. Let me just I'll not be sharing that. I'll just read out the definition from as per the new definition given. Right. So the definition has changed. Application aspect in all of those things are not changed or have not changed. So that is one thing you have to keep in mind. If you have not watched the RTP videos, please go and watch it. Now, as per the new definition, accounting estimates are monetary amounts in financial statements that are subject to measurement uncertainty. So these are monetary amounts in the financial statements which are subject to measurement uncertainty. Concept remains the same, just that definition has changed. Now, coming to this particular standard, this standard shall be applied in selecting and applying accounting policies. So whatever accounting policies you select and apply, that is one thing you will do as a part of this standard. A very important thing is changes in accounting policy is where it becomes more important as far as this standard is concerned. So what happens in case of changes in accounting policies? This will have a retrospective application. So we will restate not only the current period financial statements, we will go back and restate the previous period financial statements, and we may have to present an opening balance sheet as at the earliest period reported. So whenever there is an accounting policy, most likely you'll prepare three balance sheet. One as at 31st March of current year. Second, as at 31st March of previous period. Third, as at 1st of April of the previous period, or first beginning of the financial year of the previous period, right? So that is what is done when there is a change in accounting policy, when you have to present it. Same thing happens if there is an accounting error as well. So if there is a prior period error, you will not do correction, or you will not have a prior period item in the current period. Whichever period this particular error belongs to, you will rectify that in that specific period only. You will restate the financial statements of that period, right? Now in this particular RTP for November 23, there is a very good question on combining accounting policies, estimates, and errors. Please have a look at it. I have had a detailed discussion on that solution, and it is available on YouTube. So please have a look at it. That will have They'll give you a lot of understanding when it comes to your changes in accounting policies and estimates and errors. Okay, now just to give you a perspective, when we say we have to prepare 3 balance sheets, what do we mean is, you will prepare a balance sheet as on 31st of March of, let us say, 24, if you're talking about 31st March, then 31st March of 23 and 1st of April of 22. So these are the 3 balance sheets you prepare when it comes to your, what do you call, changes in accounting policies, or also rectification of errors, means going back and rectifying the error from the previous period reported. Okay, just give me a moment, I will plug in the charger. What are accounting policies? Please remember the definition, because sometimes you may have to apply the definition in the what do you call it, examination also. These are specific principle, basis, conventions, rules and practices. Means specific principles, rules, basis, the basis on which you apply an accounting convention. Convention, the traditional rules, rules, actual written rules may be coming from an accounting standard, and practices. All of these put together, which are applied by an entity in preparing and presenting the financial statement, is called accounting policy. Right? Now, second thing that is dealt by the standard is change in accounting estimate. Now, what is a change in accounting estimate? A very simple example could be, I created, let us say, or I charged depreciation, let us say, considering 5 years of useful life. I charged depreciation considering 5 years of useful life, right? Now, subsequently, I realized that it does not have a 5-year useful life, it has only a 3 years useful life. That is a change in accounting estimate. Okay, or there, let's say I provided provision, I made provision for bad debts at 2%. Subsequently, I realized that it is to be 3%. So that is also a change in accounting estimate. So estimate is something, estimates are monetary amounts in the financial statements that are subject to measurement uncertainty. So whenever you have monetary items in the financial statements which are subject to measurement uncertainty means, measurement uncertainty means there is some kind of uncertainty, you are not sure. For example, if you look at provision for bad debt, you are not sure as to what will be the amount of provision for bad debt, right? So that is something which is a measurement uncertainty. Similarly, when you make or when you estimate the net realizable value, that is also an accounting estimate. Or you have to determine the fair value of an asset or a liability, that is also an accounting estimate. You make provisions for warranty obligations and all of those things, that is also an accounting estimate. So what it basically means is, whenever there is a monetary item which is subject to a measurement uncertainty, right, that is what we call to be an accounting estimate. And changes in accounting estimate, changes in accounting estimate is nothing but adjustment done whenever we have, so I'll just paste the definition here. Just a moment. So this is the new definition which you have to keep in mind. Accounting estimates, the definition, please remember this. And change in accounting estimate. What is a change in accounting estimate? Whenever I have to make changes, change in the net realizable value, fair value and all of that, that is called a change in accounting estimate. Now, change in accounting estimate is different from change in or prior period errors. When I am saying it is an estimate, what I am saying is, I didn't understand practical images type teaching. This is a fast track class. If you want animated lectures, those are recorded lectures. You can buy them as individual chapters, right? So, anyways, continuing. The two distinctions that you have to make is between an accounting estimate and a prior period error. What is an accounting change in accounting estimate? When I am saying accounting estimate, I am myself not sure what should be the, let us say, useful life. If there is a change in useful life, it is not an error. I am making an estimate. But if I knew that the useful life is 8 years, but I calculated depreciation considering 10 years or 6 years, then that is an error. Error means I know some information, I know certain facts, I know that this is how it has to be done, but that is not how it is done. For example, I know the useful life is 10 years. I considered 8 years for calculating depreciation. That is an error. I knew it was 10 years. I calculated it as per 10 years. Subsequently, I realized it has to be 8 years. That is a change in accounting estimate. So students tend to get confused between what is an accounting estimate, change, versus what is an error, right? Now, what is a prior period error? Prior period error are omissions from. Omissions from meaning we omitted, we did not record something. I had to record a sale, I did not record. That is a prior period error. And misstatements. There are some misstatements, material or not material, there are some misstatements in the entity's financial statements for one or more prior period arising from. So, what are we saying? Either there is an omission or there is a misstatement where in the financial statement, how it is arising from a failure to use or misuse of reliable information. Means I had some information, I did not use that information. I had some information, I did not use that information, or I had some information, I did not use it the right way. So whatever information that is available, based on that, if I am not preparing financial statements, that can be an error. A simple example could be depreciation. I did a formula error or calculation error. So that is what we say to be a prior period error. Now, please remember, the information must be available when the financial statements were approved for issue. That is, information should be available. Let us say financial year ending is 31st of March. We are approving the financial statements in May. When we are approving the financial statements, that information was available and we should have taken that information while preparing the financial statements. A simple case could be impairment of an asset, where we knew that the asset was impaired, the asset was damaged. Because the asset was damaged, the asset was impaired. There were indicators, but we did not do the impairment. Or depreciation, we knew the useful life is 6 years, we calculated considering 4 years. So that is one problem. Or there was a sale that has happened, we knew that sale had happened, but we did not account for that sale. So anything which should have been done and has not been done is called a prior period error. For which period does it belong to? Previous period or a period before that. Errors can be mathematical mistakes. 2 1s are 2, 2 2s are 4. There we can do a mistake, right? These days, we are, even if you have to do a simple calculation, we need a calculator, and there we can do a mathematical mistake. You also do these mathematical mistakes in the examination, for which we don't get marks, right? Then mistakes in applying accounting policies. Mistakes in applying accounting policies means I know this is the accounting policy. I know FIFO is the accounting policy. I did weighted average. That is a mistake. Oversight or misrepresentation of facts. I did not take into account some facts. Let us say a check had bounced, or let us say there is a bad debt, or something fraud. Fraud is also considered. So if there was a fraud in the previous period, which we should have detected in the previous period, or which we could have detected in the previous period, that is also considered. For example, cashier took away all the cash and ran away, or cashier took away 50,000 of cash and ran away. Now, as on 31st of March or before the audit is closed, if we do physical verification of cash, physical counting of cash, then we will be able to detect that there is an error. Correct or not? If we did physical verification, we would know that there is a fraud happening. So that is also a prior period error. Sir, we did not carry out physical verification of cash. That is not correct, because that is one of the most important process you have to carry out when you are doing an audit or when you are closing books of accounts, right? Now, two things you have to understand. When it comes to change in accounting policy, there is an retrospective application. Means if I have changed an accounting policy, I will apply the policy as if the policy was always applied. Meaning to say, I will go and change the previous period financials and also the opening balance at the beginning of the previous period. To the extent I can go back, I will go back and I will change the financial statements. For example, earlier we had a policy of valuing, let us say, fair value through P&L. Now we are changing it to amortized cost method. Now, if that is change happening, that has to be done retrospectively because it's a change in accounting policy. Some specific cases, the respective standard tells us what is to be done when there is a change in accounting policy. For example, revaluation. Revaluation, India 16 gives us specific treatment. We'll do as per that only. But otherwise, any retrospective application or any change in accounting policy, we will do a retrospective application. Then retrospective restatement. Now what is the meaning of retrospective restatement? There was an error. Okay, so there was an error. So let us take this example that will help us understand. In the previous year, let us say we bought a PPE at 1 lakh. Useful life is 5 years. So depreciation should be 1 lakh divided by 5, which is 20,000. Carrying amount will be 1 lakh minus 20,000, 80,000. Okay. Now what we did was, this is the actual error that we did was, this we took 1 lakh, this we took 4 years, depreciation we took divided by 4, and WDV we took 75,000. So in the previous period balance sheet, 31st March of 23 balance sheet, we said 75,000 is PPE, but the correct scenario is 80,000. So what we will do, in the 31st March 23 balance sheet itself, when we present it again this year, we will correct this and show it at 80,000. And in the current period financial statement, we will show it at the actual position. So we showed it at 75,000, it should have been 80,000. So we will increase the debit PPA by 5,000. Where should we credit? The credit will go to retained earnings 5,000. Any questions so far? Okay, no questions. Right. Now, this is when we do a change in accounting policy where there is a retrospective application, or this is a prior period error where there is a retrospective restatement that is happening. Then prospective application. What is the meaning of prospective application? Prospective application means we will do the changes prospectively. We will do the changes prospectively. So if there is a retrospective application, we will restate historical amounts. If there is a prospective application, we will only do the changes, or we will only give the impact of changes in the current and the future period. For example, if there is a change in accounting estimate, we will only apply that in the current and the future period. And if there is a new accounting policy, please understand, change means I already had an accounting policy, I am changing that accounting policy. New accounting policy means I did not have any accounting policy. I introduced accounting policy. So new accounting policy is prospectively applied. Changes in accounting policy is also, changes in accounting estimate is also prospectively applied. Then moving on to the next important aspect of the standard, that is how do we select and apply accounting policy. Okay. Now, whenever we have to choose accounting policy, we have to first check, is there any specific Ind AS that is applicable to this standard? If yes, take the accounting policy as per the Ind AS, the guidance given in Ind AS. Second, if we do not have any specific Ind AS, some items for which if we don't have specific Ind AS, then we will use our judgment and apply the accounting policies. So if there is an Ind AS, we will apply the policy as per the Ind AS. If there is no Ind AS for a specific type of transaction, management will evaluate and apply the accounting policy. Right. Now, if Ind AS is not available, we will create and apply the accounting policy such that the information is relevant to the economic decision making needs of the users. Meaning to say, whenever there is an accounting policy which we have to choose, we have to see whether it is relevant to the economic decision making needs of the user or not, and whether we will have reliable information in the financial statement. That is, it has to faithfully present the information, it has to be neutral, it has to be prudent, it has to be complete, substance over form. All of these things we have to consider when we are choosing an accounting policy. Right. Now, if we don't have an accounting policy, Ind AS guidance on a specific matter, what we'll do is we will check if we have Ind AS dealing with similar issues. If yes, follow the same thing. If no, go to the framework of Ind AS. If that is also not there, go to International Accounting Standard Board's pronouncement. Is there some IAS for this? Is there some IFRS for this? Okay. If that is also not there, then maybe go to ICI and see, do you have an accounting standard for that? And then lastly, what is the industry practice? Right? Just more from theoretical point of view. And what the standard requires is the accounting policies has to be consistent. Consistent means you will have to choose an accounting policy and ensure that similar transactions have same or similar accounting policy. Similar transactions are same or similar accounting policies. Okay. So you cannot have one accounting policy for one transaction and another accounting policy for similar other transaction. That is why if you see, if you go to Ind AS 16, if you have to carry out revaluation, you have to do it for the entire class of the asset. You cannot say half I will do revaluation, half of the assets I will not do revaluation. Land and building, all the land and building you have to do, let us say, revaluation model or cost model. Okay. Then if there is, it's a plant and machinery, again you will do revaluation cost model consistently. Year on year also will apply accounting policies consistently. Okay, that is as far as the accounting policy is concerned. Then the most important aspect here now at what we begin is changes in accounting policy. When do we change an accounting policy? We'll change an accounting policy, or we can change an accounting policy if it is required by an Ind AS. If there is a new, if there is an Ind AS which comes out, if there is an amendment in Ind AS or a new Ind AS becomes applicable, that can be a change in accounting policy. And the second scenario is when the financial statement will provide reliable and more relevant information. If these two conditions, one of these two conditions are satisfied, we will change the accounting policy. Now, if there is a accounting policy which was not applied earlier, but we are applying it afresh, that is not a change in accounting policy. If the accounting policy chosen is very different from accounting policy which was there earlier, that is also not a change in accounting policy. And if they are immaterial, means the impact is not material, for that also you will not apply the changes in accounting policy treatment. The reason for having this immateriality criteria is that whenever we have to change an accounting policy, we have to do a retrospective application, means the work increases. Now if for small changes, if you start doing retrospective application, then it becomes a burden on the entity. That is why they have said, if it is immaterial, if you feel that the accounting policy changes are immaterial, then in that case you need not apply it retrospectively, you need not consider it to be a change in accounting policy. Okay, now again coming back, when can you change an accounting policy? If it is required by an Ind AS, or if it results in the financial statements providing reliable and more relevant information. Now, how do we account for changes in accounting policy? So whenever there is a change in accounting policy, what is to be done? If it is from an initial application of Ind AS, for example, earlier we had Ind AS 17, now we have Ind AS 116. Now, because of this, is there any, because of the change in the Ind AS itself, the accounting policy has changed. Now, how do we account for it? If already there is an Ind AS, then you check what does the Ind AS talk about? The specific transitional provisions. What does the Ind AS say? For transitioning, what does the Ind AS say? For example, if you look at Ind AS 116, it tells us how should we account for leases which were classified as per the previous standard and the current standard. Then accordingly you will do the application. If the Ind AS does not provide transitional provisions, very unlikely, but still, if it does not provide any transitional provision, you will apply for the changes retrospectively. If it does not provide for transitional provisions, you will apply these changes retrospectively. If it is a voluntary change, again you will apply for changes retrospectively. So, if the accounting policy changes because of new Ind AS, then it is considered, or you will apply the transitional provisions as per the Ind AS that has mentioned, or that has given us, which has given us the guidance. If it does not provide transitional provision, retrospective. If it is a voluntary change, retrospective. Please note, early application of Ind AS is not a voluntary change. If I have to apply Ind AS for the first time, it is not a voluntary change. Now, when a change in accounting policy is applied retrospectively, the entity shall adjust the opening balance of each affected component of equity for the earliest prior period presented and other comparative amounts disclosed for each prior period presented as if the new accounting policy had always been applied. So, as I give you an example, if in 31st March of year 24, let us say you have done the accounting policy change, then what will you do? You will recompute affected items on 1st of April of 22 and adjust retained earnings. Then you will also recompute here and adjust retained earnings, and here again you will recompute, or you will compute as per new. Okay, so not only the current period, the previous period closing financial statements and the opening balance of the previous period reported, you will present 3 balance sheets. If you have prepared, let us say, one more balance sheet, 31st March of 22, then opening balance of 1st of April of 21, that has to be adjusted. So as per Ind AS 1, you have to present a third balance sheet as at the beginning of the previous year if it applies accounting policy changes retrospectively. Now, sometimes what happens is it may be impracticable to determine the period specific effect or the cumulative effect of the change. So, we have done an accounting policy change, but we are unable to determine what is the change which is applicable in the previous period or in the prior period or opening balance. If that is the case, then you will retrospectively apply from the period or from the earliest period from which it is practicable. Meaning to say, if I see that it is impracticable to determine the changes for a given period, means what is the impact of this change in the previous period? Okay, there's a lot of calculation involved and I am not able to determine it properly, then you will apply it retrospectively from the period from which it is practicable. And if you say that, sir, it is not practicable at all, neither in the previous period nor in the opening balance, we are not able to determine, then in that case, you will apply it prospectively. Okay, so you have to see, if it is impracticable, then you will apply from the earliest period when it is possible. Now, very important here, this standard specific. In all other standards I have said you read the disclosures on your own, but here you have to say, because this is a standard based on disclosures. So if it is based on initial application of Ind AS, what is the title of Ind AS that is applied? What are the changes made? What is the nature of change? Transitional provision, description of that, adjustment to each line item affected, including your earnings per share. Retrospective application is impracticable, the circumstances that led to, and description from when the changes have been applied. If it is a voluntary change, nature, reasons for change, adjustment, and retrospective. If it is impracticable, you have to disclose it. Right. Now, as I told you, the meaning of accounting estimate has undergone a change. So the concept remains the same, but you will not follow this definition. You will follow the definition that I had given earlier. Accounting estimates are monetary amounts in financial statements that are subject to measurement uncertainty. Now, whenever there is a change in accounting estimate, why? Because we may have got new information or because we have got more experience in handling such things, right? So, if there is a change in accounting estimate, that has to be applied prospectively. Can it be related to prior period? No. It has to be based on new information, new experience. Okay. So that is how it is, a change in accounting estimate. If there is a change in the measurement basis, it is a change in the accounting policy. If you move from FIFO to LIFO, that is not a change in accounting estimate. But while calculating NRV, I have determined the NRV, with more information. That is a change in accounting estimate. When it is difficult to distinguish a change in accounting policy and accounting estimate, you will treat it as a change in accounting estimate. Okay. So, a change in accounting estimate, it results from either new information or more experience. Earlier, we used to provide 2% warranty. Now we know more customers are claiming warranty. We may provide 3% change in accounting estimate. If it is a change in measurement basis, it is a change in accounting policy and not a change in accounting estimate. If it is difficult to distinguish whether it's a change in accounting policy or change in accounting estimate, we will treat it as a change in accounting estimate only. Accounting for change in accounting estimate is basically done prospectively by including it in the P&L of the period of change or period of change in the future periods. For example, provision for bad debt will include the change in the current period. Depreciation, trade change, current period as well as future period. So here you will disclose the effect of change in estimate in the current period, estimate changes for the future period, and the fact that if it is impracticable to determine the impact of change, you have to say that it is impracticable to estimate the change in the future period. Very, very simple. Again, errors, we have seen the definitions. Various types of errors. Mathematical errors, didn't calculate properly. See, even when you use computerized system, there is a user who inputs something. There also it could be mistakes. Okay, so that is where there can be mathematical mistakes involved. You may not get wrong calculations, but you may have a wrong input, and because of the wrong input, the calculation may be incorrect, or you have applied policies incorrectly. You have applied the policies incorrectly. Accounting policies have been incorrectly applied, or you have misrepresented fact. So misrepresentation of fact means there are certain facts there which you have not presented them properly, or it could be omission. You have not taken into account a material transaction or frauds. Now you may think that, sir, how will we get to know a fraud? I give you an example, right? If there is a fraud, the entity must be able to establish the amount of fraud, right? Now, what is the accounting treatment for errors? Errors of current period should be corrected in the current period only. Okay, errors of current period should be corrected in the current period only. Prior period errors means after the financial statements have been issued or approved for issued, after that if you get an error from the previous period, that is a prior period error. If prior period error is discovered, then you will go and correct the period in which the error has happened. For example, error happened in this financial year, and we are preparing financial statement of this financial year, that is 24. Now here what the standard says is, okay, you got or you identified error pertaining to this period, don't give the impact in this period in P&L. Go back to the previous period. In that period, do the adjustment. In that period, do the adjustment and close it. So what if it was discovered prior to this? Let us say it was an error on 31st of March of 20 balance sheet. Then restate the opening balance. Correct in the opening balance. Right? So that is how it has to be done. Error discover if it relates to comparative prior period presented. Correct the material prior period errors by retrospectively restating the comparative amounts for the prior period presented. If error discovered relates to the period before the earliest comparative period presented, correct the same by restating the opening balance of assets, liabilities, and equity for the earliest prior period presented. That is, correct the opening balance. As per India's one, whenever there is a requirement of retrospective effect, an entity shall present the previous year opening balance sheet. Normally, questions are not asked, asked in the examination for you to prepare the opening balance sheet, but still, when you have to give the impact, you have to explain that you have to prepare or you have to create a balance sheet at the opening of the as which gives the opening balances of the previous period presented. Now, two, three very important items of differences that we need to understand. Extraordinary items are not covered under Ind AS 8. So, as per Ind AS, we don't present things as extraordinary, whereas AS 5 talks about extraordinary items. Then, accounting for changes in accounting policies, it says retrospective application. Here it doesn't specify. So, in most of the cases, it happens prospectively only. Right. Then, prior period errors, retrospective. Here it is prospective. Okay. So, these are the two important differences between accounting standard 5 and Ind AS 8. Do you have any questions, or otherwise we'll take a few questions from the study material for our better understanding. I would also want to show case a report, annual report. Just give me a moment. I want to show a report for you to understand. Sorry. Just give me a moment. So this is one example where you can see. So this is 1920 PNL. Okay, this is 1920 PNL. This is 1920 financial statements. Now what they have done is there is some error. There is some error and there is a change in accounting estimate, whatever it is. Now, because of that error, what all are the impact? They have done for the previous period, what is the amount and what is the restatement due to the changes in error and what is the restated amount as of 19. So this kind of reporting is done when it comes to the error thing. And here you see, I hope it's visible. Yeah, it's visible. The group has restated the financials of the comparative periods as per Ind AS 8 accounting policies, changes in accounting estimates and errors. The group restated its consolidated financial statement for the year ended 31st March of 19 as a result of a prior period error. See, they are admitting it's a prior period error associated with Group San Diego Port Agreement. The San Diego Port Agreement contains an asset retirement obligation. Now, asset retirement obligation comes from Ind AS 16 and Ind AS 37 to remove leasehold improvements at the discretion of the lessor. These leasehold improvements are necessary for the group to provide fulfillment obligation for export customers. The group had not previously identified and recorded an asset retirement obligation. The group evaluated various scenarios regarding the method and timing of ARO, and the group concluded the most likely scenario would result in the company removing the leasehold improvements at the end of the life of 20 years. However, group is currently in a month-to-month lease holdover and the liability could occur in a certain period. So all the explanation have been given, and then because of that they have corrected it, and the impact is what? PP has increased by 11.9 crores and decommissioning liability has increased by 51.46 crores with a corresponding decrease in equity by 39.56 crores. Then impact on depreciation and all of that. So like this, there can be, so the actual scenario I am discussing with you, there could be cases where because of your prior period errors or prior period errors, in this case you have restated the financial statements. Okay, now let's have a look at few questions from the institute's material. There is also an educational material on Ind AS 8 which is provided by the institute. You can have a look at the educational material if time permits, if you want extra knowledge. Otherwise it's okay, no need to bother about that. I hope it's visible. Yeah, it's visible. During year 2, Delta Limited changed its accounting policy. So they have done, the question itself is saying they have changed its accounting policy. Okay. Now, because of the change in accounting policy, what has happened? Depreciating property, plant and equipment so as to apply more fully a components approach while at the same time adopting the revaluation model. So you will apply a components approach. Components approach is prescribed by which standard? Components approach is prescribed by your Ind AS 16, right? Depreciation has to be based on components approach, and at the same time you are evaluating it, or you are considering revaluation model as permitted by Ind AS 16. Okay, then in years before year 2, Delta Limited asset records were not sufficiently detailed to apply a components approach fully. So before that year, we don't have a detailed information. At the end of year 1, management commissioned an engineering survey which provided information on the components held and their fair values, useful life, residual value, depreciable amounts at the beginning of year 2. However, the survey did not provide a sufficient basis for reliably estimating the cost of those components that had not been previously accounted for separately, and the existing records before the survey did not permit this information to be reconstructed. So they have calculated what is the fair value, residual amount, depreciable amount beginning of year 1, year 2. Prior to that, what is the component that is not known or that we are not fully aware of. Okay, now so this is where it is impracticable. You can see the case that it is impracticable. Now they determined that it was not practicable to account for the change to a fuller component approach retrospectively, or to account for that change prospectively from any earlier date then start of year 2. Also, the change from a cost model to revaluation model is required to be accounted for prospectively as per Ind AS 16. Therefore, management concluded that it should apply Delta's new policy prospectively from year 2. Additional information: tax rate 30%, PPE cost depreciation net book value 25,000, 14,000, 11,000, prospective depreciation old base is 1,500, then revised valuation 17,000, estimated residual value 3,000, average remaining life 7 years, depreciation based on the new basis 2,000. You are required to prepare a relevant note for the disclosure in the financial statement. Now, in this type of question, here you are not doing any calculation. Here you are not doing any calculation, or you don't have to do any calculation. What you have to do is you have to explain that they have changed the accounting policy for depreciation PPE by using a components approach. Sir, but changing the method of depreciation is change in accounting estimate. See, that is when you move from SLM to WDV. Here we are saying earlier we used to depreciate the entire property as a whole, but now we are using the component approach to depreciate. So why are we changing the policy? Because it will provide more reliable and relevant information. It has not been applied retrospectively because application was not practical, and hence it was applied prospectively. Then what is the impact in the previous period? We don't know. What is the impact in the current period? In the current period, the carrying amount will change by so much. Tax provision will change by so much, especially the deferred taxation. So please remember, Ind AS 8 you have to understand along with taxation. Then revaluation surplus, that part, depreciation expense, what will happen. So all of that you have to disclose in the financial statements. Okay. Then let's look at this question number 9. ABC Limited changed its method for inventory valuation in the year 2, year 3. Prior to the change, inventory was valued using the first in first out method. However, it was felt that in order to match the current practice and to make the financial statements more relevant and reliable. Oh, sorry, I am reading the answers. What are the questions? No, question. Sorry. It looked like an answer itself. A weighted average valuation would be appropriate. So, FIFO to weighted average is a change in accounting policy. 31st March of year 1, inventory will increase by 10 million. 31st March of year 2, inventory will increase by 15 million. 31st March of year 3, inventory will increase by 20 million. Now, what do we have to do? Profit under FIFO valuation model is given below as per FIFO model. Retained earnings on 31st March year 1 were 423 million. Present the change in accounting policy in the P&L and produce an extract of the statement of changes in equity as per Ind AS 8. Now here what has happened is, see, my revenue will not change. Because of change in accounting policy, what will happen? My cost of goods sold will change. Now 296, my revenue here, this 296 of revenue will not change. Okay, this 296 of revenue will not change. Cost of goods sold is 164. Now cost of goods sold is 164. Opening inventory I am increasing by 10 million. Opening inventory I have increased by 10 million. If I increase my opening inventory by 10 million, my cost of goods sold will also increase by 10 million. So 164 plus 10, 174. Closing inventory I am increasing by 15 million. So if I am increasing the closing inventory by 15 million, my cost of goods sold will go down by 15 million. 174 minus 15, it becomes 159. So COGS here, instead of 164, we will restate as 159. Then gross profit remains the same. That is, gross profit also will change. Expense remains the same. Then profit will also change. Right? That is how we will restate the P&L. Then, how we will show the statement of changes in equity? See, as the retained earning as at the beginning of the previous period is 423 million. It is 423 million. Now this 423 million, that is the retained earnings as at the previous period, opening balance 423. Then 1st April of year 1, if you present the balance sheet, that has to be restated. Then profit for the period, what was there? Earlier, what they had told profit for the period? Profit for the period, earlier they have said 58. Right? Now, what is the restated profit for the period? That you have to consider. in the current, in the restatement. Then what is the correct profit for the current period, that you have to consider and present the present balance, right? So that is how you would do, or that is how you would present the statement of changes in equity. Any question? So one more illustration, just a moment, I want to discuss that with you. This one, illustration number 8. An entity has presented certain material liabilities as non-current in its financial statement for periods up to 31st of March. While preparing the annual financial statements for the year ended 31st March of year 2, management discovers that these liabilities should have been classified as current. The management intends to restate the comparative amounts for the prior period presented as at 31st March of year 1. Would this classification of liabilities of non-current to current in the comparative amount should be considered as correction of an error in Ind AS 8? Would the entity need to present the third balance sheet? Right now, here what has happened? We had to show something as non-current. We have shown that thing as current. Okay, and we want to correct it. First thing, is it an error? See, even if you are presenting a financial statements incorrectly, that is also an error. So if it is an error, then what you have to do? You have to correct the prior period. You also need to prepare or present the third balance sheet as at the beginning of the first period presented. That is, as on 1st of April of 2020 or 20x0, you need to present the third balance sheet. Okay, then in year 3, year 4, after the entity's 31st March of year 3 financial statements were issued, or for approved for issued, a latent defect in the composition of new product manufactured by the entity was discovered. The defect that could not be discovered by reasonable or customary inspection. So, after issuing the financial statements, we got to know that there is a latent defect. Latent means hidden defect. Could we have discovered the defect by normal observation? You would not be in a position to discover that particular information. Okay, which financial year? In year 3, year 4 means after this balance sheet of year 2, year 3 has been issued, then we discovered that. As a result of the latent defect, the entity incurred 1 lakh in unanticipated costs for fulfilling its warranty obligation in respect of sales made before 31st March of year 3. An additional 20,000 was incurred to rectify the defects in products sold during year 3, year 4 before the defect was detected and the production process was rectified. 5,000 of which relates to items of inventory of the previous period. The defective inventory was reported at cost on 15,000 in year 2, year 3 financial statement, when its selling price less cost to complete and sell was estimated at 18,000. The accounting estimates made in preparing March year 3 were appropriately made using all reliable information that the entity could reasonably be expected to have been obtained and taken into account in the preparation and presentation of those financial statements. Now, what does this basically say? 31st March of year 3 is the annual financial statements approved, closure. We have approved the financial statements. After we have issued the financial statement, we discovered a defect. Now, the question here is, Could we have discovered that effect with our routine checks? No. So if we could not have discovered the effect of the defect with routine checks, then it is not an error in the prior period, because we got new information in the current period. So can we say that it is a prior period error? We cannot say that it is a prior period error. If it is not a prior period error, then how should we account for it? We should account for it in the financial statements of 31st of March of year 4. In 31st of March of year 4. We will not account for it in the financial statement of 31st of March of year 3. Okay, because as per the question also, we have made all appropriate estimates using the reliable information that we were expected to have taken into account while preparing the financial statement. So in the previous period financial statement, so the thing is, we would not have been able to discover this error in 31st of March of year 3 balance sheet, or even before they were issued. So it is not a prior period error. Because it is not a prior period error, it will not be retrospectively corrected. It is more of a change in accounting estimate, and we will account for the change in accounting estimate in year 3, year 4 financial statements, and not in previous period financial statements. Is that clear? Okay. So with this we conclude Ind AS 8 needs a lot of reading and writing practice. Okay. Needs a lot of reading and writing practice. That is where you will have grip over this topic, because theory, the concept that you write, is more important as well. You may know the concept, but you have to use the perfect accounting terminology, the India's terminology, when you're writing the answers. Right? Thanks a lot for joining in, and see you tomorrow with Ind AS 10.